Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And with us today, we have Culby Culbertson. Culby, welcome to the podcast.
Hey, Whitney, how you doing? Thanks for having me on.
Absolutely. Well, before we dive into the details of your deal, Hollyoaks and Plantation Station, a combined 180 units in Temple, Texas. Tell us a little bit about yourself, your background, and how you got started in the multifamily space.
Absolutely. So again, my name's Colby Culbertson. I'm in the Dallas, Texas area. I work pretty much nationwide. My background is organizing debt and equity for commercial real estate. So, getting into the multifamily acquisition space was actually quite a simple kind of transition. We've done probably somewhere between 300 and 350 million in closed loans as far as organizing financing. And then from an acquisition standpoint, two multifamily properties, which we're discussing now, also a self-storage, which we've converted into boat RV as well. And then also I build and sell a single family, build to rent or what have you. So pretty well balanced as far as the industry nuances, and just looking forward to learn a little bit more about your program as well.
Awesome. Well, it sounds like you have a myriad of activities going on, but let's dive into the details of Hollyoaks and Plantation Station. Again, 180 units in Temple, Texas. Let's back up the timeline. You closed this deal, you said August in 2022. Let's back up the deal. Like, how did you find this property? Was it off market with a broker? Like, tell us a little bit more about that.
Sure, absolutely. So we actually had identified this deal through a broker relationship. It was off market. The guys over at the multifamily group here in Texas were able to provide us an opportunity. Some of our investor relations came to us with an opportunity that we found was advantageous. There was a lot of deferred maintenance. It was a mom and pop operated property for, call it 20, 30 years. And they were in a position to where the individual that was owning it pretty much was taking on the entire property by himself, and he was ready to just exit, probably enjoy retirement a little bit more. And so we kind of came into the property during a time in the market that there was a lot moving. Capital markets in general was starting to becoming a little bit compressed because rates started to move a little bit, which, last, call it 2019 to 2021, pretty much linear, right? Everybody was, getting 3% rates, 4% rates. And at that time, which call it, say, March, April, May, is when all of these really started transpiring. That was in the thick of things in contracts. So there was a lot of obstacles, a lot of adversity that we actually had to overcome. We utilized a bridge product, a non-recourse interest-only bridge. And, at the time, or before this time, I guess, not everybody needed a rate cap. And in this particular case, they required us to have one because of the movement that we were having in the market. Obviously, at the time, I don't think we need that. Can we make it wider? So on and so forth. Luckily, that we all agreed to do a 2% rate cap for 36 months, which ultimately has been a savior to us. It hasn't necessarily paid us, quote unquote, but it certainly has kept us from being a little bit outside of our comfort zone. So, took on that deal. We were able to raise a pretty good amount of capital. We bought the properties for under 100 a door. We were looking at a raise that was probably somewhere in the $5 million raise. It ended up being actually closer to $7 million because of the cost of the rate cap, interest reserves, additional CapEx, closing costs, you name it. There's a lot of variables that some investors just don't take into consideration when they're doing the capital raise. So, there was a little bit of a sprint there at the end of the contract period to make sure that we had all of the dollars that were needed to close. But we all came together as a team. There was 4 GPs, myself, Brian Gramlich, Sandeep, Naluga, and Carlos and Carcion. We've all done a great job working together. And between all 4 of us, we ended up raising about $7 million to get this deal done. So From there, ended up closing in August. We did have to get a couple extensions due to what's going on in the marketplace, just to make sure we had our ducks in a row, seeing what happened with rates, so on and so forth. Basically our purchase power ability, and but now ever since we've taken over in August, we've really seen some remarkable things happen from a management standpoint.
Well, awesome. And then, that gives us kind of a great overview of the, what a lot of people's struggles were last year, right? With lending and, how do you navigate rate caps and still provide value to your investors? Before we dive deeper in the actual structure of the deal and the debt structure of the deal, let's dive into the business plan a little bit here. So the property was off market. Were there any other people that were looking at the property? Anybody you had to compete against? Like, how did you secure it, and what did you purchase it for?
Yeah, so there was a couple different groups that were competing. Luckily for us, they were out of state, and also what was going on in capital markets. I just being in the debt side, it's kind of like the sales side of financial services. I can be pretty persuasive when I need to be, and I felt that I was able to say, look, we are here in Texas. Our boots in the ground are in Texas. I understand Temple. I've been going down I-35 since I was a kid. So, I grew up in Denton. I've been kicking that same cone on the construction from Denton down to Temple since I was, I think my initials are on one of them. So I was very easy to, let them understand we knew the market and that this was going to be a deal that we could take down without having to do a bunch of creative things. And, we were going to close. So, obviously nothing is easy in this industry, but I think just as a team between the brokerage, the multifamily group that we're working with, John Krebs and his team, and then also our guys coming together and being able to provide the information as far as our management ability, our background, so on and so forth, the capital we were utilizing, we made everything completely transparent, which gave the seller the warm and fuzzies in order to, award us the deal there.
Awesome. And so you already alluded to that this property, was it one seller for both properties?
Yes, ma'am. So it was
Okay.
family owned, both properties, Holly Oaks, which is 122 units, and then Plantation, which is, you could throw a rock to it. I mean, you'd have to throw it pretty hard, but it's really close. And it's about 58 units, so total of 180. So you had alluded to a question about, kind of what our management strategy was. So here's an aspect of the property that is really unique. It is considered to be a 55 and up community. However, it's not deeded. It's more or less, that's just kind of how the dominoes fell over time. The community is quiet. It's very clean. It's very consistent. The occupancy levels stay very high. But the thing is, having that type of occupancy with that tenant profile, with the longevity of their leases, you can imagine the pushback they get when you're raising rates. I'm sorry, not raising rates. We're experiencing that. Raising
Rental rates, right?
Exactly, right. Rental rates. It's very difficult to put that on someone that commonly is on like a fixed income, whether it's Social Security, retirement, what have you. It's a difficult conversation in some cases. So there was some month to month. There was some leases that were way under market, like under $1 a foot, when the market is somewhere close to $1.30. There was little to zero amenities as far as services like Wi-Fi, trash valet, different things like that. Covered parking, which there was covered parking all over the facility, and not a single dollar was being allocated. Same thing with laundry. So there was a few different deferred maintenance products. Attributes to the property that we were able to tackle immediately, identifying new income streams, and also to the financials that were on the property. Don't get me wrong, what we had, we were able to do our analysis without any troubles, but from, call it taking it to agency after our bridge loan, we would definitely need to bring in a professional management company, get true P&Ls, start taking care of the income and expense in a documented format that we could present to some of the more institutional lenders. So that was our initial push going into the property, is identifying, how much money are we making today? What avenues are we not attacking to where we could be making more? And then based on the operations and the income statements, the P&Ls, how can we clean those up to where once we are completed with our management strategy, our exit at a bridge, to approach some of the agencies, our Life Goes, CMBS, so on and so forth.
Awesome. Okay. So a true value add strategy, but part of it seems to be like in, redoing the tenant makeup, and be able to push rents that way. So when did you walk the property? Was it before you put it under contract, or did you, have an LOI like and then walk it then? Like at what point in time did you lay eyes on the property?
So that would be back in probably April, May. So when we had an LOI circulated, we did go do just a quick drive by down there. I'm in Dallas, Texas. So Temple's, it's 2 hours, really easy, straight shot down the road. So we went down there, took a look at it. And from an optics perspective, very clean property, well taken care of. They have a lot of guys that have been working for the family for, 10 plus years. So as far as landscaping and, just the makeup of the buildings, everything looked really good. Once we got into the thick of things, just like most sellers, you're not going to do a full walkthrough until we have a little bit of skin in the game. So at that point, we were able to do full walkthrough, get our eyes on, various attributes of the property. There was some plumbing issues here and there, soffits and soffits and fascia were kind of in distress a few places. So like different things like that, we were to identify immediately. So it was good for us to get our eyes on it, understand kind of what we were walking into, literally, and then kind of go from there.
Awesome. Okay. So your LOI is accepted. You get a purchase sale agreement. You already mentioned that you had a couple of extensions built into there, but walk us through the actual framework of the purchase sale agreement. Like how long did you have for due diligence to close, the extensions? At what point in time did you have to put earnest money down? Was it hard? Those type of things.
Yeah. So we had a 15-day due diligence, which is pretty common, 15-day diligence, 45-day close with 2 extensions. If I'm being candid, that we did probably do a little bit longer extension than what the contract was allowing just because of what was happening in the market. So, we appreciate obviously the efforts of the brokerage and the sellers being accommodating for that. We did put down earnest money. I believe it was, I'm kind of quizzing me now. I believe it was 20 or to 40 grand, give or take, hard after the diligence period. And yeah.
Awesome. Did you cover anything upon due diligence?
Just
Like
making
the
sure that we had
physical, let's break it up. The physical, and then we can get in. You've already, kind of walked us through a little bit of the financial, but on the physical due diligence, did any fun things come up?
we didn't do, it's not like we did inspections going through the plumbing and stuff like that. We didn't get too invasive only because we had so much information from the seller and the brokers on the front end, but we did do several walkthroughs, just making sure that we walked it with our GC, our management company, anything that maybe we didn't think of that our property management company would be a little bit more in tune to understand. So we did several property visits, discussed with the seller several times on some of the things they found as far as, the plumbing issues in the pool or like some of the distress on the properties. But as far as the physical makeup of the property, outside of the units that were down, which there was 6 units that were down before we even took over the property. So we were able to walk through those. We saw some of the units that were not renovated at all, originals, if you will, which they were true originals too. Maybe there were some slight make ready upgrades over the years, but nothing that would ultimately be able to push rents the way that a lot of the syndications do out there. So, a lot of walkthroughs, some cost analysis, making sure that we're getting good bids from our management company, because with the bridge loan that we were utilizing, they did give us initial funding for the purchase. And then we had a holdback of X based on the bids that we were getting, the scope of work that we were seeing. So it wouldn't make sense for us to go into a property that's quote unquote value add. That's not just operational, but physical attributes that need to be handled. If we didn't do those walkthroughs with our management company, get those initial bids, do a cost analysis, pretty much saying, hey, how long would it take us to make this money back that we're putting into this property? So we did do a lot of analysis based on cost and projected return.
Awesome. Well, let's talk about the financial due diligence. So, you're going through this. It sounds like it was pretty smooth, that the sellers were pretty above board. Did anything come up on the financial due diligence at all? Like, were there units that were, economically vacant, weren't paying? How did all that go down?
There was a level of economic vacancy. Everybody loves to use the scapegoat word of COVID, but this was coming in the beginning of 2022. So let's face it, it was kind of on the tail end, and it was a predominantly older community. So there was a level of economic vacancy, but because there was there's so much longevity in those tenant profiles, they're very open with the communication. Hey, here's what I can do today. Here's where I can kind of, make sure we're made whole. But as far as the financials are concerned, my day job, so to speak, organizing debt and equity, I'm commonly going through P&Ls, running scenarios, T12, T3, pro formas based on market metrics, so on and so forth. So it was a very smooth process to understand how the property is performing, and then do a scenario based on how we're operating today. And based on those factors, how we could be operating on our exit from the bridge. So there was a deep dive in the financials, consistently getting updated financials as well, because I told you there was a few different extensions. So you figure those additional months, we have to make sure that, hey, if we're keeping our lender at bay here, we need to also make sure that we're keeping up with the financials and we're not putting a product in front of them that has changed materially since we requested that extension too. So we did stay in front of that.
Awesome. All right. Well, let's talk about the lending. You've given us a nice broad overview. This is obviously a strength of yours, but it sounds like you used more private debt, right?
Yes, ma'am.
Yeah. Okay. Floating rate. So let's get into like the nitty gritty of it. Like, is it a 3-year with 2 1-year extensions? Like, how did you, frame that all out? What was the interest rate? Any lockout periods with refinancing, anything like that?
Yes, ma'am. That's a great question. So we were able to get a debt fund, non-recourse institution or group that we've utilized before on various other transactions. So we did, it was like 65% LTV with additional costs, which put us close to 70% loan to cost, 36 months interest only with 2 extension options of 6 months, totaling 1 year. We did have a floating rate. It was SOFR plus 4. Actually, it was SOFR plus 375, which at that time was a much more attractive rate than it is today. But we did get a 2% rate cap for the duration of the term, which was not cheap. The guys that are doing the rate caps definitely have made their hay in the last 36 months. I'll tell you that. 24 months, I guess you'd say. So, but it was a bill that we just had to eat, and it is what it is. But we've definitely, quote unquote, made that back on the expense. So, just to kind of walk back through that here, we got 65% LTV, we call it 68% loan to cost, 36 months interest only, non-recourse, floating rate, SOFR plus 375 with a 2% cap. And we have an 18-month minimum interest. So that works out well for us. We've owned the property almost a year now. So, call it 6 more months. We don't have any prepay at all. Here in a little bit, once we start talking a little bit about our management strategy and the CapEx being done, it'll all kind of tie in. But I think that 18-month minimum interest actually worked out for everybody. The lender gets their debt yield. We get the CapEx that we need to complete the project. We have a rate cap, it's interest only. So I think it's so far has worked out very well for both parties on the lending side.
Now, I want to take a left-hand turn, just dive down a little bit of a tangent because you're so knowledgeable of this space. Like, one of the concerns that investors are having right now, and then also it seems like, it's a headline in the news, is
Sure.
that interest rates, I'm not going to call it clickbait, but maybe it is, I don't know. But that general partners, operators of, deals cannot raise rents fast enough or high enough to overcome the cost of capital. And therefore it could put their asset at distress. Now, I personally have an opinion on that, but like, what is your thought? Like, being an operator of a deal that you closed in the middle of all of the rate hikes with the Fed, and so you're right smack in the middle of this, but this is your jam. This is what you do. Like, what is your quick little 30-second feedback on that?
That's a great question. It's a very broad question because there are so many answers that we could go here. And I would imagine we probably don't have enough time for it, but I'd say this, our best friend Jerome Powell still feels that there's an inflation attribute to the economy that we're still trying to take over. What I've been reading, what everybody's been hearing is we still have 2 more rate hikes of likely an average of 25 basis points to come before year's end. It could happen all at once, 50 basis points, and then we sit. It could be in 2, who knows? But I would probably tell anybody to be prepared for at least 50 basis points by December of 2023. I would say that at that time, we hope, I think there's a lot of confidence that we are going to start seeing that decline in 2024, and also with election year being next year, which is its own can of worms. But 2024, I believe, with election year, you know how these the candidacies are for the people. We're going to lower your rates and so on and so forth. So I think that there's going to be a little bit of a softening from the rates perspective, and maybe open up the doors a little bit in the real estate market. But you're absolutely right. And it even goes beyond rates too, because your cost of materials are higher. Your cost of labor is higher. Your labor shortage. Right. Not everybody wants to work still. And so the combination of those 3 variables, I believe, is putting quite a strain on the real estate markets in a myriad of ways. So what I would say is, one, the rate cap is an obvious answer that you could do from a rate standpoint, but it does cost, depending on how long you're going to be in the property and what your exit strategy is. And then as far as what, if you're putting dollars into a property to achieve more rents, okay, how much dollars are you putting in? What's your actual return on that dollar? If you're going to, renovate a bunch of down units, does it make sense? How much is it per door? Coming from experience, even on this property now, we're putting in a substantial amount of capital into these down units only because we know that we can achieve a rent level, even at par, that's going to substantially, improve our NOI over time. So it's kind of it's a difficult question to answer, but I would say if we're just looking at the categories of how to answer it, we can kind of back into it. So cost of materials are high. Do we need them right now? How long can we wait to put it off to see if this will subside? As far as labor, who do we have in-house? Is this something we could do on our own? Is there a third party that we can maybe utilize? There's maybe different avenues to pursue other than what meets the eye. And then as far as rates, unfortunately, that's a variable that we can't control. We can just kind of deal with it and get through it. And I do think that there's a light at the end of the tunnel. We just don't know how long that tunnel really is. And then also how bright that light is when we get there. So I think that there's positivity coming for us, but you're right, Whitney, that we're in a place right now where people really have to pick up the pencil and start really doing some scenarios, some real math to understand what your total cost is and what that return is on your cost.
I love it. I love it. All right. Well, thank you for indulging me, first of all. I felt like I would be remiss if I didn't ask somebody who was so knowledgeable about this space that question, because I know it's on all of our listeners' minds, whether
Sure.
they're a passive investor trying to evaluate a deal, or they're an active investor trying to figure out, how confident can they be in their true numbers and their business plan, right?
Yes, ma'am. Well,
So,
one thing before we step over that, Whitney, I would just
yeah.
say that there's a myriad of different debt products available in the market that are specifically designed for short-term products like this. At the end of the day, you just have to pencil it to buy it right. These people the investors that were buying properties well above market because they were getting a rate at, say, 3%. That's all good and great. But when you sell it, now what? Now you have to sell it way above market, that a market's now since sailed. So it's okay to get into a deal when rates are high, as long as you're buying the property at a level that makes sense for your strategy and your exit. And I think that's a conversation that is lost on a lot of the investors, because it's so fun and so exciting to get into a deal. But then when you really back into what you're going to do here in 5, 6, 7, 8, 9, 10 years, when the market you're experiencing now realistically is a thing of the past, I don't think we're going to see a 3% rate, especially a sub 3% rate in our market and in our lifetime. No crystal ball here, but that'd be a pretty aggressive assumption.
No, thank you. Thank you for expounding on that. Well, I'm interested about the raise on this because you did raise capital for this particular property. So tell us how you structured the deal for your limited partner investors, and then also tell us how the deal was structured, with 4 general partners.
Yeah, absolutely. So, myself and Brian, we're both minor partners in the deal, sub 20%, which if anybody is curious why we did that, in a underwriting process, the majority partners, 20% or more, are commonly fully underwritten. Those that are minority partners, are obviously inundated in the deal, very much so involved, but it's not as much of a full court press on the underwriting. So Brian and I are minor partners. Carlos and Sandeep are on the majority partners, and they've got a myriad of experience with some larger multifamily properties. The raise that we did, they did obviously a fantastic job. Carlos and Sandeep raising, close to 5 million. And then Brian and I, which Brian played a major role in this. He's great in the industry. He's been doing it for a long time. We did probably about 1.5 to 1.7 between he and I, working with different groups that he's familiar with, some investment relationships, things like that. And as far as the structure is concerned, we had 8% pref with some type of, you're quizzing me now again, but I've got the PPM. I'd have to refresh it here. But it's an 8% pref, and I'd have to look into it on the total return. But we do quarterly distributions, which we have not missed one yet, even amidst some of the operational deficiencies we've done. Everybody's gotten a check every quarter so far. We plan to do distributions again here shortly. So, that's been pretty exciting to be able to stay on top of our plans so far.
Mhm. And what about the split with the LP's GP? Like, on the back end split, is it like a 80-20, 70-30? Is there any other IRR hurdles or performance hurdles in there?
It was a 70-30 split. And then I think it was a 15% IRR hurdle. It might have, again, I apologize. This is kind of caught me off guard here. I thought we were just talking about the management, but I can break out the PPM. I've got it somewhere, but I know
No
there
worries,
was
no
a
worries. And then,
15% IRR hurdle of some kind. And the split was 70-30. So I think everybody was pretty pleased with the structure. Everybody knew there was quite a bit of deferred maintenance. So, they were even intending to, we told them, hey, it may be a couple quarters until we can start sending some checks out. So, but we ended up, achieving a little bit more than we anticipated as far as occupancy levels. So our distributions actually started a little bit sooner than we expected. So it's been a positive experience so far.
awesome. And then what about the fees on the deal? Was there an acquisition fee, asset management fee, disposition fee? Like,
That's a great question. So we had management fees, and we have an asset management fee that was 2%. And we had an acquisition fee that was at the time going to be 3%. Because of the hurdles that we had, the additional capital we had to go back and raise, so on and so forth, us as the sponsors decided to mitigate that acquisition fee just because, hey, we've already kind of put our investors through a little bit of a curious scenario. The last thing we want to do is get into this deal with a bad taste in their mouth. So we mitigated that acquisition fee. We actually did not collect anything at close. We went ahead and just kind of underwrote a scenario to where we could kind of pay that back over time as opposed to getting it up front. We are still doing the 2% asset management fee for obvious reasons. There's a lot that's going into the deal, which this just as well as I do, Whitney. It's definitely not just to pick up a phone call and hope everything's going okay scenario with these types of properties. There's a lot
yeah.
that goes into it. So certainly earning that 2%. But yeah, so we did mitigate our acquisition fee. Obviously that's not the point of us getting into the deal. It's obviously having a successful operation was a little bit more important to us, having a good relationship with the investors. Not to say that we won't get that paid over time, but we were cognizant of the reality of the acquisition. So we did waive that initially. So we try to keep it cost low as we enter the deal.
I think that's and I hope listeners picked up on that, as your deal is changing, right? The underlying fundamentals of the deal is changing. How can you, as the general partners, work out a package essentially, that, not just is optically good, but also good for business, right? And keeps everybody, the general partners and limited partners as partners, right? Because at the end of the day, we all make money together and we can all potentially lose money together, right?
Yes, ma'am.
So just in wrapping up, I would have a couple questions for you. What did you
Sure.
find that was easy during this process that actually ended up being a little tougher than you thought it was going to be? And then what did you think was going to be harder that you actually ended up being easier?
So I honestly thought that the capital raise was going to be a lot easier than it was, with a a rising rate environment, with a myriad of different things that were happening, the geopoliticals, all that good stuff in the marketplace. It was just much more difficult than we anticipated. I told you candidly, out of mind a little bit of vulnerability, right? It took us a little bit to raise that money amidst such a peculiar time in the marketplace. So it was definitely a challenge. Luckily, I was working with a team that had just as much charisma, I guess you'd say, as I did. So, Brian was hustling every day, making calls, doing what he needed to do. I was hustling, making calls, doing what I needed to do. Sandeep and Carlos doing the exact same thing. So it really was a meeting of the minds of four guys that had a purpose. And, we didn't have to talk every single day to know what we needed to do. So every morning we woke up, we were on the phone, and we met up once a week to talk about what we were doing. Ended up achieving that goal. But I would say, Whitney, that was probably one of the bigger challenges I've had in my real estate tenure over the last 5 years. What I thought was going to be much more of a challenge was the property takeover, handling all the economic vacancies, getting the 6 down units done, getting all the deferred maintenance, the plumbing, the trees removed that were dead in the streets, and the carports that were decrepit and all that good stuff. Actually, it ended up being a lot easier than we thought. We have a great property management company that we have an outstanding relationship with. We all link up once a month, talk about what's going on. There's a consistency and improvements from as far as occupancy, physical and economic. Things are getting done. A lot of the deferred maintenance that we had in front of us are now completed, smoothed out. Now, literally today, we signed a contract with the GC that I'm really good friends with, that he's going in and getting all that work done. We're going to have those completed and live in 4 weeks. So just so many great things happened, the domino effect. So it's almost kind of like God saying, hey, I'm going to challenge you on this first part. And then if you achieve this challenge, we're going to give you a little bit of an easier scoop here. So it has been a really great experience coming in to one, work with such a great property management company, and then two, the sponsors and, the third parties, GC, stuff like that coming together, with a purpose in mind. It's made it very smooth. And I'm really looking forward to the next 4 to 6 weeks once these get done. And I'll be on my social medias, LinkedIn, Facebook, stuff like that. I'm going to post the progress, and we're really impressed and pleased with what's been happening from an operations standpoint.
And that's awesome. Well, Colby, thank you so much for spending your time with us here today and your expertise and insights. If people want to find out more about you and reach out to you, how can they do so?
Absolutely. So like I said, my social medias are great. Facebook, LinkedIn, just Colby Culbertson, Culby Culbertson. And then my email cc@culbertsonholdings.com, which is actually in my LinkedIn too. So would love to connect with anybody interested to see what type of acquisitions are available in the market. If they're looking at something, to get some type of advice on how to get it done. I'm an open book. I really like chatting with like-minded folks like yourself, Whitney. And yes, this has actually been a pleasure of mine as well. Thank you so much for having me on.
Of course. Well, again, thank you for sharing your time with us here today. And we look forward to hearing about your future deals.
Thank you so much.